right, great. Unless any of you have any questions to address to the House, I would like to invite the Prime Minister to start the debate. Here.
Right, can you hear me, guys?
Yeah.
All right, just give me a moment. I'll just set up my timer. And yeah. Okay.
Hello, Anang, can you mute your mic? Ananga, mute your mic.
Okay. Sorry, wait. Right. Three, two, one. This debate works in the idea of analyzing it in terms of how HFTs analyze information and how that affects the risk value of different assets that they invest in. We noticed in the 2010 flash crash that a lot of companies who were trading in stocks and then trading through these HFT programs were largely responsible for how the index, for I think this is the Dow Jones index, that forced them to drop 1,000 points, and therefore you lost a lot of value for a lot of investors who were involved and damaged through this, right? I think it shows to you two things. Firstly, that a lot of HFT, a lot of high frequency trading likes to operate on creating issues and problems out of small pieces of information. Because at the point in which the stock market was operating on a normal scale, suddenly you had a lot of computer operated technologies that were generally making sure that generally caused a more rapid drop in the stock market to unreasonable levels, right? I think even with the amount of fixes the from a negative side tries to put here, do you think that they're still prone to some degree of intermachinery error when there are glitches in systems in terms of how these things operate in the long run? Clearly, let's just establish this out of the way. We ban things on affirmative side, especially in terms of business, when these things are too incredibly complex to regulate. So in the same way that we banned mortgage-backed securities in the 2007 crash, because you understood how incredibly complex it was to be able to process this and therefore have it regulated to a reasonable extent, since we're talking about milliseconds and milliseconds of data, which is where high-frequency trading operates in, we think that this is the same instance where we have to ban these things on that level, right? I'm going to have 2 points of substantive to you to be able to show to you why this is necessary. The first thing I want to focus on is how high-frequency trading interplays with the stock market and how, generally speaking, there are harmful, extremely harmful trends that we think exist because of these mechanisms in the first place. The first thing you have to understand is this. High-frequency trading operates on 3 levels. The first is that they operate on algorithms, which are most likely to be proprietary secrets. So if it means you have a slew of high-frequency trading businesses, it's possible that they might be able to collude and specify certain algorithms so that they can game the system on that extent, and therefore make sure that they will be the ones who earn the most and leave other people who don't subscribe to HFT trading out of the dust. But secondly, there's a clear and explicit large level of buy-in, wherein only big companies who can afford the severe millions of cost in accessing terabytes and terabytes of RAM or these expensive processing units to be able to process at the fastest rate as much as possible. It means that the only people who will be able to benefit here are those very big corporations in the first place who can buy into these things in the first place. The third thing you have to understand is because there is so much information being rapidly processed at a pace like this, and that it's blocked off to big corporations who can afford these things in the first place, the small investment companies are the only ones, are the people who are going to be lost, who are going to lose out on the benefits that are accrued under the side of the house, right? I think on the second level, circuit breaker systems aren't even enough in the first place, right? Because at the point in which you create these circuit breaker systems to be able to limit the harmful impacts that are provided by these high frequency trading, it closes the trading at the point if the change surpasses a certain amount, but it doesn't close the trading at the point in which these the percentage already exceeds that amount, right? So the idea is, it only closes the trading right after the stock value increasing severely drops, right? Because it still means you can still lose money. The fact that these things bypass circuit breakers shows to you that if they all drop, if the stock value of these assets, these HFTs are currently invested in, drop at the same time, that's generally bad, right? So I think it means 2 things, right, under this first point of substantive. The first thing we say is, with the amount of information that is being rapidly processed with on the status quo, it means you're likely to have a lot of savings and a lot of investments get completely wiped off the map. That means that a lot of the people who are invested who have these pension investments or these these minimal risk money market bonds suddenly lose their value just because you have a lot of these what do you call this, high frequency trading businesses investing in a plethora of assets. Because you have to remember, HFT businesses are not confined to just operating with high risk assets, right? They're also allowed to possibly invest in other assets that might be able to also help them get more money in the first place, right? I think it wipes out the savings on the first level. The second thing we say is it discriminates people who invest in the long term, because if these people don't have the risk appetite to be able to absorb the harms that are created by these HFT trade, by the impacts of high frequency trading, I would say a lot of their investments, ranging from their retirement homes to the mortgage funds that they invest in, are generally screwed over because they're competing with these businesses and these rich corporations who can afford to invest in high frequency trading and pull out of the investment the moment it starts going downhill, right? So I think that the meta here is simple. Why do we think this is important? Because we force these companies and we force these individuals who are currently invested in high frequency trading to opt for more safe options that are generally not just helpful for the economy, but also helpful to other investors as a whole, right? I think the general problem with under this first point of substantive is these people who generally create high frequency trading are into the mindset that it's all about making sure that we can get the most amount of returns as possible while making sure that other people who are in the same investment in the same stock market also lose out in the first place. Because if you don't ban these things, a lot of the harms are very irreversible. We think it's likely to invite things such as decreased investor trust, less money moving around in the stock market, because now there's more people who are scared of the impact and influence of these high frequency trading systems. We think we want to avoid those things as much as possible. The second thing I want to point out here in this point of substantive is how this hurts a large majority of investors from accessing investment opportunities, either through the stock market or through other safer investments. So I already told you how there's already a large barrier to entry to investing or creating your own high frequency trading system, right? But I think it has to go to the second level. What if we can try to make sure this is also accessible to the poor and middle class individuals who also might be interested in investing the same things? What if we lower the barrier to entry so they probably just have to pay for the HFT business and just, like buy for certain stocks, and then the broker will analyze these things accordingly? I think this is still problematic for two reasons. One, if more people invest in the high frequency trading, it increases the volatility of these stocks, considering that if you have more people who are currently invested in certain stocks, that it's likely to increase the volatility of these stocks, because you now have more individuals who are rapidly pulling in and investing out of certain stocks. So I think that the volatility increases it. Considering on a second level, the information that is really being processed here is strictly focused on the absolute technicalities of the stock market, right? I think what you have to note under this is that high frequency trading doesn't consider things like black swan events or political events that are generally good reasons for people to pull out of these things in the first place. I think a lot of that is also important because the mindset of people investing in the stock market also has to consider how their assets will be influenced by political events. A lot of that is left out of the picture when you have high frequency trading, because in these cases, it's easy for people who have that high frequency trading to be able to gain as much as possible and then pull out the moment they see the moment their algorithm that detects a technical issue. It's not very easy for other people who are invested in these things in the first place, right? We in fact say this is similar to insider trading, where if in insider trading you are very certain that certain changes these kinds of changes will happen in the stock market. We can say with the same thing that if like high frequency trading operates with a certain amount of certainty, then it's very much fair for us to say that they're already gaining the system. It's already being harmful in the long run. What do we think? What do we say is the impact here? First, on the first level, if more people absolutely buy into this form of high frequency trading, it increases the volatility of your assets and therefore makes the stock market more sensitive to changes. I think it impacts a lot of investors, a lot of markets, and a lot of economies if this is the model. If it exists as an option, we already told you how it clearly gains the system, right? So what's our impact here, and why do we think this is better on the affirmative side? One, we force the people who engage in these kinds of tradings to operate for more fair fields and to change their mindset into operating in an area that is safer for the entire entire communities, right? You have to understand that this high frequency trading can also affect them. If their businesses are screwed because of the same high frequency trading, I would say there's also enough reason for them to be able for us to ban these things on the long run. I think I already listed to you why high frequency trading is harmful on two fronts. I think we need to be able to make sure that this is prevented in the long run. Thanks.
All right, thank you very much for that. Elo.
Hello, am I audible? I am audible, right? Yeah, okay. I'll start in 3, 2, 1. panel, affirmative loses this debate because they're just wrong. The high frequency. I'll first characterize to you what people who invest their pensions and their savings in, what sort of markets they invest in, and what sort of markets high frequency traders invest in. Second, I'll talk about why regulation is possible. Third, I'll talk about why it's justified, and fourth, I'll talk about what the alternative would be if they were to be banned. But firstly, notice that normal people invest their savings for the long term, right? That is to say, they hold their shares for periods of 1 or 2 years at least. And they also invest in things like blue chip companies like Apple and Walmart, and they mostly invest in equities of well-known companies or whose markets are relatively simple. On the comparative, high frequency trading requires you to trade in large volumes and sell at a very short time, which means the fundamental requirement for high frequency trading is that you need to have large amounts of liquidity within the market. This amount of liquidity simply isn't available in normal equity markets, which means that it is contextually untrue that high frequency trading operates in the same markets as the ones where people invest their savings in. But secondly, it is just not possible to trade in those high frequencies in the same markets, right? So what high frequency trading companies primarily focus on are currency markets, because they do so because these currency markets have large amounts of liquidity. That is, they have large amounts of free flowing cash, which makes it easy to buy and sell at large volumes in short periods of time. This is not possible in a normal stock market, which means that the existence of high frequency trading companies literally has no impact on the lives of people who invest in equity markets and who invest their pensions in in these blue chip companies, which means that the comparative that affirmative brought to is false to begin. But thirdly, notice that these high frequency trading companies are only allowed to use data that is available in the public domain, right? So their methods of analyzing that data are very complicated, but the data that they use is available to everyone to begin with. That they do not see them as gaming the system or being unfair to the system, because what they're essentially doing is they're utilizing already publicly available data in a better manner, and I'll talk more about that later. But secondly, why is it possible? Here, affirmative told you that because these methods are too complex, they cannot be regulated. But crucially, regulation does not depend on the methods used, but they depend on the outcomes of the methods used. Which means that even if the trading methods are extremely complicated, the outcomes are simple to measure. You can see if a high frequency trade has caused a large market crash, and you can reasonably guess if a trade has been done by due to insider trading. Which means that things like circuit breakers and regulations against insider trading, which already exist in the status quo, can also be applied to high frequency trading firms, because you literally do not need to know what method they use to arrive at to decide which share to buy and which share to sell. You only need to know what the impact of that buying and selling is, and the point at which you see that the impact is very large or that it has caused a large fluctuation in the market, you can apply a circuit breaker and you can probably prevent that high frequency trading firm from trading in the future, which means that regulating them is also possible. But thirdly, we tell you that they haven't done any wrong, right? What they have essentially done is that they have designed algorithms which are able to use publicly available information to decide which currencies to buy and sell. We think what they're essentially doing is they're finding a better way to utilize information that is already available. We say this is principally no different from what traders do. We think, given that a large amount of skill differential already exists between human traders, which means that some human traders are able to use the same available information to make better decisions than some other traders, and these better traders always get more profits. We think high frequency trading also essentially works on the same principle, and because affirmative cannot stand on banning better traders or traders with more expertise, we do not see why they can use the same metric to ban high frequency traders. But even beyond that, we tell you that people investing in the stock market aren't entitled to profits to begin with, which means that if the existence of a firm means that the amount of profit other people get from the market is decreased, that is literally not a reason to ban that firm. You enter the stock market fully consenting to other people also being able to enter into that market, and you aren't obliged to get any level of profits, right? if their case is like poor and middle income people will get screwed over, we do not see why they necessarily have to invest in this in a very complex financial market in order to increase their earnings. We're fine with like better government regulations and better government welfare to take care of these people. But finally, we think that it is best if the market is able to react to information in the quickest possible. This is something that can uniquely be done by high frequency trading companies. We think that when you're able to like buy and sell extremely fast, the market is able to extremely quickly react to certain changes in the information available. So if the market sees that a country is doing badly and its currency is likely to fall, we think high frequency trading companies are going to sell off their shares of that currency. We think that given that this happens quickly means what essentially happens is that capital flows from countries whose currencies are probably doing better from countries whose currencies are doing worse, right? We think objectively that is a good thing because the principle of a market is to punish bad behavior, bad financial behavior, and we think that is better achieved through the existence of high frequency trading firms. But note here that the burden for banning is far higher, right? They can't just say that X, Y harms might occur because of the presence of high frequency trading firms. They needed to prove us why in the absence of these firms, those harms will never happen. And that is the burden that they haven't taken. Now, then moving on to what would happen if you decided to ban these firms, right? Notice that the potential for making money within these currency markets would still exist, which means that the space that was previously occupied by high frequency trading firms would now be occupied by banks and other companies, right? They would not employ these algorithms, but they either might use human traders or they might use algorithms that trade at lower volumes and trade over longer periods of time, which means that all the harms, if they do exist, and we have told you that they do not, but if they were to exist, would still exist symmetrically even on their side of the world. Because the only thing that changes from a high frequency trading firm to a normal trading firm is that the decision which was taken in 1 second is now going to be taken in an hour. But notice crucially that the decision is going to remain the same, which means that if the presence of the high frequency trading firm means that a currency would drop by 5% in a second, that 5% drop would still happen, but it would be spread over an hour. Which means that for investors who invest in periods larger than an hour, who are like day traders or invest in longer time periods, there is literally no difference between a high frequency firm and any other investment firm like a bank, which means we aren't sure what banning these firms actually achieves. But finally, we tell you that given that all of this is true, we have heard no reason why we should prefer one type of company being able to dominate the market over a high frequency trading firm. And that is also a burden which they need to take in this debate. Panel, at the end of this debate, note that people are not entitled to profits within a marketplace. If the existence of the firm means that people's profits are reduced, that is not a reason to ban that firm. They have to show us how that firm engages in malpractices and how those malpractices would be reduced by a ban. Until and unless they do so, we win this debate.
All right, thank you very much for that, DPM.
Hello. Is this volume okay?
Yeah.
Okay. Hold on. I shall just charge my laptop because I don't want it to cut during.
Yeah, go ahead.
Okay. High frequency trading is a bit like an arms race because if you know that other companies are going to divest first before you, if you know that they will be the faster ones and be the ones to escape before the circuit breaker kicks in, you will want to be even faster than them. It creates a sense of escalation where everyone wants to, where any company that's investing in these securities will want to act faster and faster, will want to respond to more minute changes in the stock market, will want to be able to trade in larger volumes precisely because they want to one-up the other company. The result of that is an incredibly volatile and incredibly fragile market that crashes in response to even minor changes that don't reflect any real world economic events, any real world like failures that might want to divest the company, but that one algorithm decided that might want to divest a bit, another algorithm picked that up and divested again, and again it happened until the market actually crashes. So we think that kind of volatility is not good for investor and encouraging investment, and it's not good for like people being able to make sure that their money is safe and their profits are safe. But secondly, we think that all this like gambling, all this like lottery of what is profitable and what is not, trying to play the stock market and fight the algorithms against each other, is a lot of wasted investment on things that could have been more useful. So for example, if people no longer feel they can comfortably invest in these markets where like you're basically just playing the stock prices, you'll probably have more long-term investment in things like healthcare and things like actual companies that provide tangible goods and services to the people. And I think this is fundamentally a state interest because it's able to cater benefits towards the most vulnerable and like to a larger consumer base compared to stock trading that deals in really complicated mathematics that no one really understands. And the other team has not been able to clearly say how this benefits the people. So I think that's a comparative that they have to defend, where the price of high frequency trading is lost investment in the economy that actually helps people and actually tangibly benefits the people on the ground. So I'm going to have two constructive discussions in this speech. The first is the idea of a principle. Is this a form of anti-competitive or otherwise harmful behavior? Two, I'm going to talk about the macroeconomic effects, how it's like how high frequency trading discriminates against the poor and makes investment generally less easy, right? First, I want to talk about the principle. They said that it was not a form of insider trading because, oh, it's accessible to the public anyway. I mean, technically, yes, but if you ask a real person to do all the complicated math that this algorithm does in microseconds and be able to do it at that same pace, I don't think that's something a real person can do. And I don't think like someone, even with like a PhD in accounting or something, is going to be able to do on the same level. So even if it's technically publicly accessible, it's probably not in practice, given that it's such a high burden for the public to actually access these things. Secondly, I think this actually is a form of insider trading towards the companies that participate in these algorithms. Why? Because suddenly, if their clients subscribe to these companies, they know the algorithms with which their clients will invest and divest. They know what kind of stock market operations will result in like them investing. And it allows these corporations to also do in their form of insider trading because they're the ones who know what the algorithms say and they're the ones who know how these people react. So I think to some extent it does offer unfair advantages. But thirdly, they weren't able to respond to how it provides unfair advantages to the rich who can afford these these high frequency trading machines in the first place, which is oftentimes because of the high startup costs and the intellectual property loss and the like maintenance of very complicated servers. These are things that are expensive and only accessible to the rich and like the upper middle class, which is incredibly harmful because when a market crash does happen, those people will be able to get their money out. Those people will be able to beat the circuit breaker, but the poor who probably have more at stake, who probably have more the more risk of their entire savings being wiped out, are probably not going to be able to access these high frequency tradings. And given that it's reacting to a minute change in the stock market and not a real event, probably just wake up one day and notice that their savings are gone because some algorithms decided that might be more optimal strategy. I think that kind of discrimination is like really bad, but also enough of a basis to restrict the right to your savings. Recognize we do take efforts to redistribute money to the poor. We do take efforts to prevent things like insider trading, and therefore the state doesn't just let the free market go wild, but actively needs to protect the most vulnerable. The next thing they say is but it doesn't matter because these are completely different kinds of asset classes. The first response is like necessarily why? Like if these algorithms believe it might be profitable to also say buy and sell at high frequencies blue stock chip companies, which are by the way also incredibly profitable, then I don't see why they wouldn't do that. Like there was just an assertion coming from them. But secondly, even if it's a different asset class, if the news article at the time says this asset class crashed and the overall market is going down, it'll probably lead to a panic that affects other asset classes and other forms of equity as well. That means you still have those kinds of market crashes happening. So the example here is a 2010 market stock crash where there was no like intervening market event that made these things. It was just a bunch of really fast trading machines that happened to crash at the same time, and it made a lot of other investors panic. So we do think it does lead to more flash crashes. So why do we think the impacts of this are? Firstly, we think you're likely to see a lot less investment. So, for example, a lot of people who are cautious and don't want to engage in a volatile market because they care about these sorts of things are probably going to not invest their money in this market in the first place. People do saving, you reduce consumer spending, you reduce the ability of people to like benefit from money changing hands in the economy. The second thing is that you punish uniquely investors who are not willing to do this. So we agree there are things like pension funds that like want to have more stable and long-term investment, which means they will most likely not engage in these high-frequency trading machines that are perceived as short-term and incredibly risky. What does that mean? When the market crashes, they're ultimately the ones who are left out and all lose their money. What does that mean? That means that your like grandparents who want to have their pension protected are probably going to be punished. The rich investors who engage in this high frequency trading are probably going to be fined. The last thing I want to talk about is the idea of consent, because they said that well, the people are able to choose to enter this market anyway, and they probably consented to having the savings wiped out in the first place. Firstly, like the fact that your savings got wiped out is still an objectively bad thing, even if you chose it. But given the incredibly obtuse nature of the algorithms that happen within these machines, they probably didn't consent to it. They probably were just sold by a bank saying, look at this technology, you can get a quick buck, but didn't really understand the repercussions of what they were doing. And we told you, the incredibly microscopic, mathematically hyperbolic, complicated formulas mean that people are never in a position to understand what these trading machines are doing. And we think you need to safeguard the people from investing their life savings in things they don't fully understand. But even if this is accessible to the poor, we told you that the risk is simply too high. We do not want them to be able to have their savings wiped out by these kinds of companies. The last thing I want to talk about is this idea of international investment, because they said, oh, you make it easier when foreign country markets and currency exchange rates subside. The first problem is that I don't see why this is a particularly good investment that the state wants to encourage. Because if you're just trading on exchange rates, your investment isn't tangibly providing any goods for society. And that's one of the state's mandates when it comes to the economy. Encourage companies like healthcare, like education, that are going to help society and they're going to benefit people on the ground. The problem is, if it's just exchange rates, that investment doesn't go anywhere. If anything, it only goes to the pockets of the rich. Therefore, we ought to encourage more tangible and more long-term forms of securities. That's why we think it's incredibly beneficial that this investment is now being moved to stable securities, moved to things that actually help people, and are not just locked in the richest game of one-upping each other. We think the market is less stable, and we think even if it were not less stable, it wastes money where it is not needed and where it is not beneficial. We're incredibly proud to propose.
All right, thank you very much for that, DLO.
Hello, am I audible? Okay, just give me 10 seconds. I'll just start my timer. Okay, I'll start in 3, 2, 1. Two premises before I begin my speech, right? First premise of this debate is that people are not absolutely entitled to profits just because a market exists, right? We think people enter into a market knowing that they're providing money to a particular entity by buying a particular stock. They know that there is competition within the market. They know that other people are operating within that market with similar information available to other people. And they know that they might make a loss if other people are able to make better decisions based on that. Let me be very, very clear at the beginning of this debate, right? Some people trade based on random hunches, right? Which even like complex computers can't explain those hunches. Some people operate on some targeted information, right? Like what kind of CEOs exist with a particular company, or what kind of trading practices does a particular company do. A lot of people operate on various different hunches, which are probably more complex and unexplainable, right? A lot of people do act based on that information. In that context, it's absolutely unclear to me why a particular machine learning algorithm or why a particular algorithm that an HFT uses is so very problematic to the other people, right? Just because a general population cannot understand something doesn't mean that the people who can understand it should be like denied the ability to trade in that particular market, right? Let's clearly first beat the metrics of banning in this debate. The first metric that they said is that it is too complex to regulate. Firstly, Machine learning models are literally used in every single industry. They are black boxes. Literally, no one can understand them. Literally, no one can explain them. But the only way in which it is legitimate to intervene and it's legitimate to regulate them is by knowing the impacts, right? We think often governments and all regulatory bodies know the impacts of trading and know the impacts of high frequency trading, right? When they see like a trade has happened at a very, very large volume, they know that prices will fluctuate to a certain extent. This is precisely the reason why we have things like circuit breakers, why we have things like stop limits, etc., right? Because the government and like other regulatory agencies know that they can see the visible impact of a large trade, and that's precisely the only legitimate way to intervene when complex machinery is involved. Because otherwise, like just go and ban every company that uses complex machinery, right, for manufacturing, for literally any other task, right? Like machine learning models are used to optimize credit risks, right? Like credit risk scores are generally given out based on machine learning models. Just go ban them because they're complex to understand, right? We don't think that's a metric. Secondly, they said you are gaming the system because you're using really, really complex algorithms. Let's be very, very clear in this debate, right? Those companies have designed those algorithms and they know that they're utilizing publicly available fair information. On the contrary, there are other traders who can utilize that particular information other ways, which could be more skillful than the average poor person. We think, therefore, the harms that are largely symmetric, only that they happen over a longer period of time. That is to say, HFTs can cause that kind of information change in like 1 second, but other traders who are more skillful than you will cause that change in 1 hour. We think the reason why HFTs are fair is because there is no objective understanding of what time scale it is fair to use information in, right? It's unclear why it's unfair to use information in 1 second, but it is fair to use that information over a period of 1 hour. But the second reason why we think it's illegitimate to ban HFTs because of this reason is because we think faster, like a faster reaction to information is often good for the market, right? This is precisely at the basis of the efficient market hypothesis, right? The reason why the efficient market hypothesis is true is because it assumes that the markets are best operated when you utilize data faster. Let's be very clear in this debate. The reason why they think efficient markets exist on their side is that people, based on their own hunches, people based on their own understanding of the market, will trade on securities. They'll probably profit, they'll probably lose, they'll probably make a loss, but then the prices remain stable. But the premise of that price remaining stable is that you want companies, and you want the companies that are being publicly traded being accountable to the public, right? That is to say, if they do malpractices or if they engage in bad practices, you want people to react to those information and harm those companies, right? You want people to react to those information and buy and sell companies. We think given that you want people to react to information in all sides of the house, we think a faster reaction is necessarily good, right? Because it makes information clearer to the public. When you know that an HFT has made a large volume trade, you probably get an understanding whether or not you should buy or sell in that particular company. We think that information is often good for people. The only analysis that Affirmative had here was that it happens too fast, a lot of volatility exists, and people might lose out on money, right? The problem with that argument is that there is massive levels of self-regulation within the market. So for example, if an HFT sells a large number of shares, and that probably makes the market volatile, and probably a lot more people want to sell their shares, that naturally creates buy incentives for other people, right? Because when a large number of people decide to sell their shares, prices automatically go down sufficiently, which means buy incentives are created for other people who don't believe in that particular information, who believe that this company might grow up in the future, right? We think this kind of self-regulation always exists, because if a company either goes too up or too down, the corresponding sell and buy incentives are naturally created in people's mind, right? Because people's incentives to operate in a market are entirely different. If, for example, a company's prices increase massively, some people choose to hold it because they think it will rise further, or some people choose to sell it because they want that profit instantaneously, right? Given that people's incentives are entirely different, we think any kind of volatility leads to corresponding buy and sell incentives in the minds of other people, which creates massive degrees of self-regulation within this debate. The second thing that I like to note here, and this is extremely important in response to the previous speech, right? They said that we think HFTs are also not very volatile, right? Because we think different HFTs compete in that same sphere, and they're very different algorithms being used, which means all of those algorithms don't give the same outcome, like just buy everything or just sell everything, right? We think often that creates a separate degree of self-regulation. Third thing that they say is that if HFTs make a particular decision, everyone would want to make that particular decision. We think if that decision is in line with the information that is publicly available, that is a fair decision to make at the very get-go. Lastly, we think that the Affirmative said was, you are forcefully moving people to other equities if they think that they can't compete with an HFT. We think that is completely fine. If people can't understand complex traders, or if people can't understand complex markets, people naturally move to other places, right? You don't ban more skillful traders because people think they lose out because of more skillful traders, right? We think that's never a metric to regulate markets to begin with. Lastly, the thing that they said was extremely glib, right? That they said, trading on currency doesn't benefit society at large, right? We think that is ridiculous. In the vast majority of the cases, what HFTs and what trading on currencies literally does is provides money to companies whose information that is publicly available makes you think that the company is more profitable, makes you think that the company is going to do good in the future, right? In that context, giving those people more money essentially translates benefits to society. If they're able to manufacture goods at a better level, if they're able to provide better services to the people, we think giving those people more money essentially translates benefit to society, right? But at the offset of any of it, like anyone trades in a market for profit, like literally no one trades in a market to benefit society at large, right? That is ridiculous for them to place a burden on people who are trading in society to cause benefits at large, right? The alternative that they proposed is that this is wasted investment which could have been otherwise utilized in healthcare, right? This is literally an assertion. I have no reason to believe why people who have like savings and people who have like pensions are going to invest in healthcare and welfare system, right? They're going to literally find other government bonds. They're going to find things like public provident funds, etc., which are relatively safer and where high frequency trading doesn't exist. We think people are going to shift over there. Literally unclear to me why they're going to move towards more social welfare or more healthcare in this debate. The last thing that I want to make clear in this debate is why on a comparative they literally create no change in society. The harm that they propose is that in the short span that HFTs utilize a particular information, a lot of volatility exists. What they only do by banning HFTs is that more skillful traders will utilize similar information in similar ways, or different ways for that matter, but create some shift in the market over a period of 1 hour. That means anyone who trades anyone who's a day trader or anyone who's a long-term trader who trades beyond that period of 1 hour already has that information available to them, right? Already knows that something has happened within the place of this 1 second or something has happened within this space of 1 hour, and all my future decisions have to be contingent on this, right? Therefore, the only people that are harmed on their side of the house are people who are making those similar decisions in that very short period of time. But people who are making long-term decisions, which is the vast majority of people, are benefited because the market becomes more efficient and they have more information to react, right? We think on that metric, they have no metrics to ban this, but on the contrary, we think there are certain benefits that HFTs have. Very proud to oppose.
All right, thank you very much for that. Gavwit?
Hi, am I audible? All right, I'll just pull up my timer. Give me a moment. Okay, I'll start in 3, 2, 1. I have 3 issues to crystallize the win for side affirmative, right? First is, are the regulations enough? Second, is HFT essential for trading? And second, where can we better accommodate the smaller companies in the stock market, right? So on the first issue about regulations and whether or not are they enough, we think that this issue is very important because the clash of side negative is that there is no need to ban because regulations are enough. So if we have proven you why it is not working, why regulations are not enough, therefore it is justified to ban HFT. Therefore, they lose this issue. What did they say? They said that, oh, regulations are enough because you can see through algorithms when the stock market is crashing. So when you see that the stock market is crashing, you can enter, you can intervene, and you can regulate it. This only proves that they can regulate this. They can regulate, right? But they didn't prove why these regulations are effective because we think it is otherwise. Because yes, you can see the highs and lows of the stock market, but it will be too late for you to know when to intervene or when to regulate. Why? Because the trading flow is happening in the milliseconds. It is happening in a faster speed, right? So therefore, these kinds of regulations are too late even if they can be implemented. Therefore, the effectivity of those are questionable, right? This is something that they haven't responded on their case. It's late for the third negative speaker to respond to this. Furthermore, I want to bring back the idea that was begun by my first speaker when he talked about the secret propriety information, that you do not know whether or not it is faster than the circuit breaker because they can completely see what. So this means that if affirmative says that they can completely see what is happening, we think that this is not the case because these investors do not know whether or not they are moving faster than the circuit breaker, right? So this issue means three things. First, if they are talking about regulations, this is so unclear for me because they didn't prove what are those regulations and how are they working in the status quo. Second, they didn't prove why these regulations are effective, right? They simply assume that, oh, there are regulations, therefore we shouldn't ban this. Thirdly, we think that the harms of HFT is hard to be controlled because it is moving fast and you cannot see it, that even if you have regulations, it is too late. Therefore, the banning is justified, right? So we think, therefore, regulations are not enough. On the second issue, is it essential for trading? What did side affirmative say? They said it is essential for trading because we have to react quicker information in the market. We need to move fast. Notice that this is their only argument to prove why we should support HFT. Therefore, if we prove you why this essential benefit is not necessarily vital to trading, therefore they lose this benefit. Because my first question is, why do we need to move fast? Why do we need to be fast in trading? Because side negative didn't prove it otherwise, right? Secondly, we think that it is okay for you to move slow, for the trading or the stock market to happen slow, right? Why? Because A, you're better able to consider the ongoing changes of the stock market. So if it is slowly dropping, you're better able to check it for yourself if you want to hold your stock or sell it to others. Versus in HFT, if it drops immediately, it's good if you pull out, good for you, but it is bad for those investors who are not checking their portfolio, who didn't pull out of their stock, right? So what does this mean? This means that, therefore, that these kind of delay in trading or being slow is very important for the investors to think and to be sure about their decisions, right? And we think that this is important in the stock market, which operates on the system of trust. Secondly, why being slow is okay, because it limits price gaining. We saw this a few years ago when Google suddenly received 40 millions in stock. It affected investors who were just too slow when the HFT buyer who gave that 40 million pulled out. Therefore, this means that these affects these smaller investors should the bigger investors pulled out, right? And we think that this harm is inherent to HFT. So the point is investment is high risk and you cannot simply make it too fast. And I think until the second speaker of side affirmative didn't even said the justification as to why we should indeed move fast in this economy, right? Why is this important? This is important because all the arguments of side affirmative can only stand if they prove that we're operating on a stable economy. But Madam Chair, we think that we are indeed operating on a global recession where economies are fluctuating, where economies are unstable. Therefore, we should move slower. We should move more surer in our world, right? Because of this instability. So, third issue about how can we better include these smaller companies? What did we say? We claimed that these HFT isolate smaller companies because these HFTs are too expensive. Their costs are too high because you need to buy high processing units. You need to buy a lot of technology. Therefore, the impact is only big companies can opt into these kinds of HFT, right? What are the impacts of this? We think there are two. First, Small companies are being drowned out because they cannot keep up with the market, because the market is dominated by those companies who has HFT. This is bad because A, you disincentivize investors to invest to these smaller companies. And why is it bad? This is bad because you provoke unfair competition. You only incentivize investors to invest to big companies, to those who are hard to fail, right? Therefore, it yields to an unfair market because you isolate the smaller ones. The second impact is small companies will try their best to keep up. This is us engaging to their very best case that maybe HFT is accessible. We think even on their very best case that we do not isolate the small companies. We think that this will deal to volatility of the market because many are investing in and out in the stock market. So if you get more people to invest in HFT, it affects stocks. It affects the stocks to be more volatile because of these investing in and out, right? So what does this mean? This means that even on their very best case, it still isolates, it harms small companies because of these kinds of volatility in the market. And what happens in the volatility, it further harms the smaller companies because they have less safeguards in this fluctuation economy, right? So before I add my speech, I want to clarify two things. First is, sure, we concede that they are entitled to profits, but they are also entitled to shield themselves from the risk and immense drops in the market. Therefore, they do not need to move fast. Secondly, we think stock affects and influence industry operation too. So we think, therefore, we win this debate. Thanks.
All right, thank you very much for that. What?
Can you confirm that my voice is clear and audible? Can you confirm? Yeah. Can you hear me? Oh, perfect. Just give me a second. 2, 3, 4, 5, 6. Just give me a second. What's this? Okay, yeah. Starting in timer. Sorry, I'm at plus. Yeah, starting in 3, 2, 1. The reason side F falls out of the debate is because they fail to understand what the way markets work and the way markets are differentiated between different actors, right? And this was right there in the beginning of our first speaker. They never engaged with. All responses will be integrated. I'll have 3 clashes in this debate. First, on whether there exists, if any side has an unfair advantage and where that exists. Second, impacts, and third, on the I'll do a quick run by the principle. First, let's talk about which side has an unfair advantage. The first thing I want to talk about here is competition. First, we told you right from the beginning that markets are disjoint. We told you that different market for an Uncle Joe and an HFT firm. We were very clear in the reasons for this. And right in the first speaker, the way HFT firms make money is by making us a trade with a very large volume and which is a very small margin, right? Which is to say, each trade might make like a millionth of a dollar, but they'll make a million of those trades very quick to make $1, right? And that's how they basically work. But that necessitates that the market should be big enough to support that million trades, which is why they only work in exclusively the biggest markets. These are currency swaps. Uncle Joe doesn't happen here. But there are also other reasons for this, right? We tell you to operate in the kind of markets they work. You need something that's called an ISTA contract, right? International Standardization of Derivatives Association contract. That requires you to have a $1.5 billion as a basic capital to buy in, which means they're saying, oh, small firms and Uncle Joe is harmed is an absolute lie. We give you a analytical reason in terms of like the scale that's needed on why Uncle Joe isn't there. And we also give you like a basic reason on like a regulatory reason on why these markets are separated. But also note that what this means is that the competition that then exists is between the foreign HFT firm is between other HFT firms. Like we think this exists largely between HFT firms, and secondarily it might exist with trading firms, like for example, a big bank's trading desk. And then we tell you, given markets are destroyed, we think competition is not a problem. The second thing to note about on the unfair advantage is regulation. First, we tell you, let's add responses over and above my first 2 speakers and direct responses to regulation. Like we tell you, there's a massive incentive within these HFT firms to behave. Why? Because if they misbehave, they are fined at 3 times the cost. And we told you in our first speaker that big fines explicitly that 3 times the cost, 3 times the money they make. Which means there's a monetary incentive. But note there's a loss for it. If you lose your investors' money, which you would, people also you can shunned by industry and can never work in the industry again. So there's an incentive in terms of being excluded from the industry. Thirdly, we tell you like these fund managers, the kind of people they are, they care a lot about their reputation within the industry, which means they don't want to get like their name dragged through the mud, which is another incentive for them to not misbehave. We tell you the strong incentives in terms of within these firms to not misbehave, money locked out from future participation for the markets and reputational costs. And note all of this is direct response to the other side and should be counted towards the debate, right? But we also tell you that regulation works after something happens, right? Which is to say, even if circuit breakers are reactionary, regulation being reactionary is not a metric to say it's not good, right? Which is to say, even insider trading is regulated only after that insider trading is done. Like there is no pre-regulation, there is no pre-punishment. We don't think that's a metric. That's a standard. But note, if they want to say circuit breakers don't work, we think circuit breakers are equally fast as these algorithms, which is to say the algorithms don't have an unfair advantage because the circuit figures are equally fast. The last thing to note here is that the comparative. We tell you, compare it in the absence of these HFT firms, it's going to be like trading desks of big banks that are going to make those trades inside of 1 second in an hour. But we tell you, these people, regular people, can never react as fast as these traders anyways, which is to say, if these traders will take an hour, probably like regular people will still take more than a day to understand the reasons for that. So anyways, markets will always be like this in terms of like regular people, even if they were competing, not being able to compete with these professional traders. We think this is not a reason to ban anyways. Like the last thing to note here is in terms of money and interest and like complexity. We tell you there's in all worlds, the money that's being flowing is all of the rich and upper middle class, which is to say we think poor people don't have money to invest in stocks on either side. They're never investing like in any form they talk about or we talk about because they just don't have the money. But even if they want to talk about pension funds, we tell you the big and worth billions of dollars and high frequency trading firms often cater to them. So access isn't really a problem in any sense. But the advantage from being more sophisticated, we tell you, is principally okay, right? We think it's better to be a smarter debater. We don't handicap like smarter people in debates. We don't think it's unfair to be like better, given like we already told you standards. We think it's inherently fair to succeed by being better. People don't understand, but on the comparative, people don't understand complex traders on their side anyways. So the metric of like being more complex to ban isn't okay because traders are also far more sophisticated than a regular Joe who's trading. The second clash on like impact side. First thing to note here is in terms of what their harms were. Their harms were first that investment is wide. But note if the stock is falling, clearly it would have fallen on either side, and professional traders would be better anyways, right? They would be faster to react, faster to understand what's happening, and faster to do it. Which means on the comparative, their harms would also exist. It doesn't matter if it happens slowly or fastly, because professionals will always be better than your regular Joe. That is not irrelevant. But note to the extent that the harm they push is a flash crash. We tell you flash crash is something crashes immediately, recovers within 5 seconds. Nothing is wide. If I hold a stock of, if I bought an Amazon stock today, a year from now, it dips in value for 5 seconds and then recovers. I didn't actually lose anything. We think nothing is wide. That's irrelevant. But lastly, on the idea of risks are increasing. First, we think markets are very risky. People understand anyways. But we think to that extent, like marginal risk may increase. We think that's probably okay, right? Given it's fundamentally fair. But we think their idea of saying, oh, look, minor changes for crashes is an absolute worst case, and it's not happened. It's not like contextually true, right? Which is to say, HFT firms exist. Markets are not nervous wrecks. We don't think that's true. We don't think that's comparative. We don't think that to the extent they want to talk about that happens. But not where money goes. Where the money goes if there are no HFT, right? They say, oh, it goes to societal benefit. Ridiculous, does not stand. It probably goes to the traders that do the same trades in 1 hour instead of 1 second, which means there is no benefit on the comparative. There is no benefit of that idea. But what were the benefits that we brought to you, right? We told you there's a benefit of free markets being efficient, which is actually truly good for society, right? And what is that? We told you how are markets more efficient? HFTs are better able to utilize publicly available data, and this looks like prices changing based on those data. But not only HFT firms are able to utilize this data on the scale and time they have, which means they're able to drive the prices for fairer value, and that is how they exploit markets to make money. Right? We told you fairer markets are good, right? Because and like why this happens is because bad firms go bust because they're not able to like do fair valuation, but the good ones are able to like drive prices for fairer value over the longer term are the ones that do exist and make money and like exist in the long term. Why is this good for society? because you participate in the market on the basis it's fair. On the basis it's better for all if the market is fair. We tell you if something is underpriced and HFT firms comes in and drives the price up, that benefits the sellers. Similarly, if something is overpriced, it benefits the buyers if HFTs exist. The comparative is this unfair benefit happens on their side. We tell you over the accumulation of that unfair benefit is a true principled harm on both sides. Let's get to the last comparative I want to talk about on the principle. Right? We told you the principle of free and fair efficient markets is what the entire system is pinned on, right? We tell you slower means inherently more inefficient, which is not legitimate. You are not, like they say you are not allowed to act in the slower market. We tell you that's not fair. That underpins the basic principles that the market is based on. We think those principles have to be upheld for the integrity of the entire capitalist monetary system. We tell you regular people are not day trading anyways. They're professionals, which is why even in their harm, we think that harm accrues to professional traders. They probably should increase their sophistication. Anyways, we tell you smaller investors are always affected, so don't see additional reform, but anyways, they're probably in a different market. Their recession framing concedes that they're okay with HFT firms in growth periods, which is a massive concession that alone should win us the debate. Don't let that go unspoken about. But it's not based on but the debate should be just on who gets free and fairer markets. Anyways, we're very proud to oppose.
All right, thank you very much for that. And to wrap up the opposition bench, I'll reply.
Hello, am I audible? Okay. I'll just start my timer. Starting in 3, 2, 1. Panel, the reason why markets exist and you allow people to trade on a market is that you want people to make certain decisions, and based on that, you want the fairest possible price to be achieved in the market for that particular stock. In that context, we think given that we already allow people to do that and people already do it based on publicly available information, we told you that it's better that we reach that fairer price in the fastest possible way where HFTs are able to quickest utilize that particular information, right? 2 questions in this reply. Firstly, whether or not it's justified to ban these things. The only thing that we heard from affirmative here is that you can't regulate these spaces because of milliseconds and circuit breakers aren't fast enough to react. Notice that this idea of circuit breakers was assertive, that they said circuit breakers aren't fast enough. We can similarly posit that circuit breakers are fast enough. The way in which you resolve this particular clash is by just thinking logically. Governments have an incentive to regulate. We think in general, market crashes are not good and governments would like to invest to regulate. In that context, we think governments are likely to take the best possible technology circuit breakers, which are similar electronically to the kind of machines that HFTs use. In that context, we think it's much more believable that circuit breakers are equally fast in terms of reaction compared to what they say that they are not fast. But given that it was largely an assertion from them that they aren't fast, it's not enough for an adjudicator to buy that. We gave you 4 targeted other responses to why there is possibility, why there is regulation, right? We first told you that HFTs inherently trade on publicly available information. Therefore, they already compete with other HFTs on the basis of different algorithms, which means there is inherent competition within different HFTs. The second thing that we told you is that this happens in a very short span of time, right? Which means people who are largely trading over a day or trading for a long term can consider this information that happened because of that crash or because of that whatever change in market, whatever fluctuation, whatever volatility, right? That creates additional buying and selling incentives in people's minds based on the way in which price fluctuates. We think it's fundamentally good that people are able to assess this particular information. People are able to react to this buy and sell incentive, right? Given that companies inherently keep giving you buy and sell incentives, it's unclear to me why HFTs reacting on a particular information, creating differential buying and selling incentives is inherently bad. The third thing that we told you is that there is a natural incentive not to misbehave, right? You are shunned in the market, governments find you, and that's why it's not something that you would do. Insider trading, panel note, that is also regulated based on where it happens, right? You can't assume that there is possibility of insider trading and ban that particular company from just existing, right? That is ridiculous. Second thing that we heard on the metrics of banning was that small companies are harmed. We think this is quite uncomparative in this debate, right? Because notice that people are allowed to use their own brains and people are allowed to use that technology and internet available to them to make particular decisions, right? We think these are inherently differential things. People have different kinds of brains. People use different kinds of metrics to decide whether or not to trade. People have differential computers and internet connections. We think that difference always exists, right? There's no the metric of banning this just because the technology is much more superior is quite arbitrary and something we haven't heard a principled justification from side affirmative. The third thing that they said is poor people are significantly harmed, right? We give you two responses here throughout our three speeches. Firstly, we said there are largely different stocks, right? HFTs rely on large amounts of liquidity. They rely on large volumes because they know that they are going to exist in the market for a very short period of time. They want to capitalize on that very small shift in price, and therefore that's going to happen. That's why poor people are inherently different in this debate. But secondly, if poor people are harmed, they're symmetrically harmed on their side of the house, right? Skillful traders and people with better computers are going to make those trades faster than you, are going to create that same kind of change, same reaction to information on your side of the house. It's ridiculous to believe that poor people won't be harmed, right? If your premise of poor people being harmed was that they don't have the capacity to understand information, that capacity to not understand information is symmetric on this. The benefits that we give you is efficient markets and principle to not harm these kinds of things. Efficient markets literally mean that you are able to drive the prices to the fairest possible value in the fastest possible period, right? We think this is inherently good. Their alternative of societal good is uncomparative. People literally exist in the market to make profits. They're not going to invest in hospitals and healthcare. What they'll invest in is other funds like provident funds, mutual funds, etc., where probably HFTs don't exist, right? This debate is literally not about the alternative. They had to prove the metrics to ban a company. We don't think they've proven. Very proud to win this debate.
All right, thank you very much for that. And to wrap up the entire house, got reply.
So I think it's incredibly unfair for the other team to say that our logic of the poor being locked out of investment because they cannot keep up with the rates that these high frequency trading things happen, and that recessions will happen on our side as well, is incredibly uncomparative. Because yes, both sides will have to deal with recessions and crashes to some extent, but to the extent that we have shown they're more frequent on their side, to the extent we have shown that they are more likely to start for reasons that don't tie to any economic reality on the ground, but simply because an algorithm got triggered and it triggered a bunch of other algorithms. We think that markedly worse on their side because they have a more volatile market that is unable to be regulated. It's incredibly difficult for people to be able to invest in. I'm going to have two issues. So the first is, where is the market more stable? Secondly, does this right to divest exist in this instance? Firstly, where is the market more stable? Because what they said was, you can like, if it goes down, it goes back up, right? So I think this is an incredibly bad faith response to the argument. Like, it doesn't respond to the fact that people will lose their savings when it goes down, that companies will go bankrupt when they, like, their stock prices has collapsed, that even if they don't, that it's still an economic loss and an economic damage when people are unable to like recuperate those kinds of things. Secondly, they weren't able to respond to the impact that because of this volatility, it scares off a lot of investment from happening in the first place. So even if, yes, it does recuperate, the fact that it's so volatile means it's more likely that a lot of things that would have been invested in like somewhere in the economy are otherwise saved or otherwise put into things that don't have that kind of volatility. So we think that's incredibly harmful, and they weren't able to respond to that. The other thing they said was, it's okay, we can regulate it anyway, and therefore there won't be crashes. The first problem is that their mechanism doesn't deal with two characterizations that we gave. The first thing is that they weren't able to deal with the characterization. It was an arms race. That's to say, you're always trying to go faster and faster and faster constantly, meaning that there's more competition to increase the speed of these high frequency trading versus a circuit breaker that's kind of just there and doesn't have to compete with anything. The second characterization they weren't able to respond to is the idea of proprietary information. So governments don't know if the circuit breaker is faster. So we don't know if they so we don't say like it's going to be made aware of it until it's too late and the circuit breaker has been beaten. So we think that makes it incredibly volatile and difficult to regulate these markets. So what the harm they have to deal with is these people have lost their money, these people have lost their savings. And even though, yes, on our side, some traders are more skilled than others, we think the debate is about a comparative, which is that, yes, there are more skilled traders, but they do not have access to the like millisecond speed information that is so much faster than the human brain. Those kinds of unfairness are massively magnified on their side, and it's much more unfair, and they weren't able to justify why that was okay. Second idea, is this a form of insider trading, and is there a right to divest here? They said that it's publicly available, but they weren't able to talk about why that public availability was accessible. We said it was so much faster than the human brain. But the crucial analysis from my speech that was not responded to was that because these companies are aware of the algorithmic decisions of their clients, are aware of the math that goes into what they're going to do in the stock market, it is still a form of insider trading because they can then use it to predict the actions of their clients, predict the actions of these people, and use that to get an advantage. And that's amplified precisely because we told you, even from first, this is incredibly hard to detect and incredibly hard to explain because it's happening in milliseconds. It's very difficult to catch these things in the act. And all their incentives about being caught and public shaming don't apply simply because of the incredibly complex, incredibly high-speed mathematics that this does. So we think there are no incentives not to get caught. It does enable insider trading. It is incredibly unfair that only these rich companies are able to access that. What we're able to show you in this debate, we don't think that the right to divest is absolute. It comes at the trade-off of the economy. It comes at the trade-off of the poor, and they have made no effort to defend why these people have a right to have their savings wiped out and their lives ruined by this policy. Thanks.
All right, thank you very much for that debate.